Okay. Hi, everyone. This is a nice lecture of Monetary and Financial Economics B2. Today's topic is about financial globalization. So today we will cover these two contents, the problem of bank failure and the challenge of regulating international banking. So today's topic is about banking. So the problem of bank failure. Banks use borrowed funds to lend or purchase other assets. If some of the borrowers become insolvent or the value of the bank assets falls for any reason, banks may not be able to repay short-term liabilities such as checking accounts. So a bank's financial health also depends on the trust that depositors and other creditors have in the bank. For example, if the bank is very healthy and there is no problem in bank's financial account, but then depositors thought that the value of many of the bank's assets has fallen. So please care about that. The bank is healthy. The bank is healthy and there is no problem in financial accounts. But then depositors withdraw their deposits and place them in another bank. Even if the bank is healthy, the bank faces sudden and massive loss of deposits. It is bank run. So it's called bank run. So even if the bank is financially healthy, a bank faces bank run. So therefore, the trust is important. Trust of depositors and creditors are very important. So even if the bank is healthy, but depositors thought about the financial health of the bank, then bank actually faces bank run. Banks are closely tied to each other by mutual loans and derivative contracts. So therefore, a bank failure or bank run causes another bank run. So therefore, it leads to a chain of bank runs. It's called systematic banking crisis. One bank crisis or one bank run causes the another bank runs. So it turns out to be systematic banking crisis. So bank has a problem. So let's check the problem by checking a bank balance sheet of the bank. So this is an example of bank's balance sheet. There is asset side and the liability side in the bank's balance sheet. So balance sheet has asset and liability side. In asset side, there is loans, marketable securities, reserves at central bank, and cash on hand. Cash on hand is very limited, just about $25. The most common asset is loans and marketable securities. But loans are illiquid because if bank lend to others, then it takes so time to come back to bring back the loans, pay back the loans. So loans are illiquid because it takes time to pay back the loans. Okay, marketable securities can sell. Marketable securities can be sold and then convert into cash. They can convert into cash, but there is some possibility to be lost. So because the value depends on the market, So that depending on the market structure or market situations, the marketable securities can be lost. So there is uncertainty about the value of marketable securities. On the liability side, there is demand deposit, time deposits, and short-term wholesale liabilities and capital. So demand deposit is so banks need to pay demand deposit immediately if the depositors say depositors require the payment. Okay, demand deposit. The bank needs to pay demand deposit immediately if the depositors issue or require the payment. Time deposit and long debt had high interest rates. So the important thing is that bank's balance sheet has term mismatch. Okay. On the asset side, there is illiquid loans and uncertainty value of the marketable securities. So these two things are hard to convert cash by certainty. So marketable securities have uncertainty about its value, and loans are illiquid. But on the liability side, banks need to pay deposits immediately. So to pay the deposit, banks need cash. But on the asset side, there is few cash, only to $25. So term mismatch occurs. Liabilities to be paid immediately is greater than asset like cash. Okay. If asset is short and banks have not enough cash, they cannot pay to the depositors. Okay. So therefore, term mismatch occurs if liabilities to be paid immediately is greater than the assets, like cash. Okay. Capital is difference between assets and liabilities. So there is $200 as capital. So the ratio between the ratio of bank capital to total assets of a bank is the total asset is $4,000 and the total capital is $200. Then the actual ratio of bank capital to total assets is gonna be 5%. It means that the bank can withstand losses of up to 5% until a bankruptcy. So therefore, if the ratio is 10%, then the bank withstand losses of up to 10% until bankruptcy. Therefore, high capital ratios make banks safer. So this idea is based on the bank's self-capital ratio. So there is some government safeguards against financial instability, including bank loan. First one is deposit insurance. Second one is deposit reserve requirements. Third one is capital requirements and asset regulation. Fourth one is bank inspections. Fifth one is lender of the last resort. And finally, government restructuring and bailouts. The first one, deposit insurance. The government give compensations for the bank depositors for losses up to a maximum amount. So this is insurance for the bank depositors. Even the bank faces bank run or bank failure. Deposit reserve requirements is the requirements to the banks to maintain deposit reserves and hold a portion of their assets in a highly liquid form like cash. Third one is capital requirements and asset restrictions. It sets the maximum bank capital requirements and limiting the holding of high-risk assets. As mentioned so far, high bank capital ratio makes banks safer. So therefore, this capital requirement set the maximum bank capital requirement to obtain the bank safety. Fifth one is bank inspections. Inspections by banking supervisors. Examine compliance with capital adequacy ratios and other regulations. So this is bank inspections. Central banks or other financial authority check the bank's accounts and supervise the bank's financial stability. The lender of the last resort is that obtains loans from the central bank or institutions made available by the central bank. Loans are available to banks facing large outflows of funds to meet depositors' claims for I can't pronounce that, sorry. Reimbursement. Okay, reimbursement. Crimes for reimbursement. However, healthy bank management is a requirement. Okay, so lender of the last resort is a special treatment for the banks facing larger outflow of funds. So if bank faces the crisis, the large outflow of funds, and they cannot meet depositors' claim, then central banks or other institutions lend to the banks. Okay, so this is the last lender of the last resort. Okay, this figure illustrates the banking crisis, systemic banking crisis during 1970 to 2011. So the vertical axis is the number of the ongoing banking crisis, and the green bars are emerging and developing countries' banking crisis, and the red one is advanced banking crisis, advanced countries' banking crisis. You can see that during the 1990s, the number of systemic banking crises increased and decreased around the 90s to 2000s. And also you can see that these large number of systemic banking crises are basically in emerging and developing countries. There are only few cases in the advanced economies. But after the global financial crisis 2007, the banking crisis also increased. And notable point is that the number of banking crises in advanced countries are increased. Here. So during the 1990s, the major banking crises are in emerging and developing countries, but now after the 2007, the advanced economies banking crisis are notably increased. So therefore, the recent banking crisis are in the advanced economy. So government safeguards on banks can be divided into two parts. The first one is emergency support assistance to banks and banks' customers. So if the bank faces bank run, deposit insurance or lender of the last resort helps bank. The second one is disincentives for unwise risk-taking by banks, such as deposit reserve requirements, capital requirements, and asset regulations, and bank inspections. So these policies prevent banks to take risky activities. The deposit reserve requirements and the capital requirements and asset regulations, bank inspections prevent the high risk-taking activity or behavior by banks. So this is a very, very, very important topic, moral hazard. So moral hazard is a potential for failure to take precautions to prevent accidents because of the insurance. So deposit insurance or access to lender of the last resort can cause moral hazard. So in the emergency, even if the bank faces emergency, but such policy makes government help bank. So even if the bank take very risky action, for such policies make government help banks. Therefore, banks has incentives to take very risky activities or risky behaviors. Bank supervision and balance sheet restrictions prevent such risk-taking behavior by bank. And so, therefore, bank supervision and balance sheet restrictions are necessary to limit the moral hazard created by the deposit insurance and access to lender of the last resort. If a financial institution is systemically important, which means too big to fail, or too interconnected to fail, management and creditors expect that the government to have no choice but to support the institution. Then moral hazard occurs. So financial institutions like too big to fall institutions, of course, so if such too big to fall institution actually fail, then the economy crashes. So to prevent such economic crash, government needs to help the financial institution. If the experts or creditors know the government help, then moral hazard occurs. Such institutions borrow cheaply and take risky strategies. Then it's resulting in high profits make it even more too big to fail. Then vicious cycle occur. And then too big to fall institution cannot never fall by government's help. If such government help is known by is understood by creditors or management, then the financial institution actually become too big to fall. Okay, so to prevent such problem, too big to fall problem, the bank supervision or balance sheet supervision are necessary to prevent this problem. Okay, the next part is the challenge of regulating international banking. Okay, so let's check the second topic in the next video.